Hello everyone, and welcome to today's webinar that will review the highlights, answer your questions, and offer suggestions on how companies can get the most from the results of the American Supply Association's 2013 Operating Performance Report, also known as the OPR. Please note that this one-hour webinar is being recorded for replay. Everyone registered for the program will receive a follow-up email message with notification as to when the replay is available, as well as instructions on how to access it and the presentation slides. I'm Chris Murin, Executive Director of ASA, and before we get underway, I'd like to be sure we recognize our 2013 supplier partners who are truly dedicated to the positive development of the PHCP and industrial mechanical PVF industry through ASA. When making key decisions in your business, please consider these corporate partners that go above and beyond with their support to advance the association's efforts, programs, and services through advocacy, education, networking, and business intelligence. One of the association's strategic goals is that ASA members will be more profitable and sustainable as they deliver world-class supply chain efficiency in a changing marketplace. For more than 30 years, ASA has partnered with Industry Insights Incorporated to provide the only source of industry-wide financial and operating performance benchmarks for the PHCP and industrial mechanical PVF wholesale distribution channel. Today, the annual OPR is part of a growing suite of industry intelligence reports that provide ASA members with reliable and timely industry data to use when making strategic decisions that fuel growth. ASA also partners with Industry Insights to produce a monthly flash report on profitability, sales, inventory, headcount, and average day sales outstanding, as well as confidential business valuation appraisals. It's now my pleasure to introduce our presenter and an all-around good guy, Tom Noon, who founded Industry Insights in 1980. Tom's expertise primarily includes the areas of financial analysis, business valuations, profitability planning, and productivity improvement strategies. He has served as project director in a variety of research and consulting studies for both U.S. and European public and private firms, as well as numerous trade and professional associations. Additionally, Tom has played a major role in both the design and presentation of executive development programs in the United States and Western Europe. And if you read the Wall Street Journal, U.S. News and World Report, and a number of other trade magazines, you may even recall seeing him quoted. Now, before I turn it over to Tom, I want to make sure that everyone is clear he or she is encouraged to ask questions throughout this presentation. While it would likely be very difficult to have all of us on a conference call, your GoToWebinar control panel includes window panes in which you may pose questions and even chat with other participants, panelists, and organizers through the use of your computer's keyboard. I'll help Tom to monitor the control panel for your questions, and periodically he'll be asking us if we have any for him. By the way, you can minimize and maximize the GoToWebinar control panel by clicking on the orange arrow in the upper left-hand corner. Tom, take it away.
Well, thank you, Chris. First of all, I'd like to thank everyone for taking time out of their busy schedule to be here today with us for this session, which is titled Don't Leave Profits on the Table Using the ASA Operating Performance Report, or OPR, as Chris mentioned. As you probably already know, the OPR is a benchmarking type study that provides you with financial and operating barometers against which to compare your own company's performance. Each year, the study involves a number of different financial and operating ratios and provides you this additional way to help control your business, recognizing that there is no true apples-to-apples comparison to your company, but you can get a lot of insight about your business just by looking at how you compare to your industry peers. So what I would like to do in the session today is I'd like to spend just a couple minutes sort of reviewing why this information is important, and then also talk about what it is not, and try to, throughout the session, give you some insights on how to use this information and apply it to your own business. I'll also spend a couple minutes talking about the economic climate sort of in picture or graph form, because when you're analyzing your own company's performance, it's obviously important to have this as a backdrop as to what is happening around you, and that impacts performance, obviously. Then I'll get into looking at the actual highlights of this year's study, which is the 2013 study of 2012 results. So we can take a look at what's happened within the industry, not only for the most recent year, but over the last 5 years. Then I'll turn my attention to another type of analysis that we do every year when we do this study, and that is that we look at what we call the profit leaders, or the high profit companies, and try to determine what separates them from the other companies in the industry. In other words, why were the industry winners winners? The idea here is to try to determine what leads to high profitability in the industry, so that maybe you want to focus on some of those things, same things. And when I do this analysis, I'm going to show the results of both plumbing supply firms individually and also PVF firms, and looking at all respondents versus the high profit group of companies, so we can look at in both segments of the industry what might lead to high profitability. And the way we define the profit leaders for this purpose is we look at one ratio, before tax return on assets. And we look at that profitability ratio, and we look at and pull out the top 50% best performing companies based on that measure. Put them in a group by themselves, and then run all the means and medians and statistics for that group of companies. And what you'll find is that for some measures, the high profit or high profit leader companies do better than everyone else. But there's other measures that they don't necessarily do better than other companies in the industry. So the idea here, again, is to try to focus on the things that have led to their high profitability. Once I've done that, I'd like to shift gears a little bit and talk about something else that I think is critically important to all companies in the industry, and which also is ties in very nicely with the OPR, and that is something I call partners for profits, distributors and suppliers. And what I mean by that is that I think that historically there is oftentimes an adversarial type relationship between distributors and their manufacturer vendors. When I say an adversarial relationship, I mean that both distributors and the manufacturers sort of have short-term goals very often, and they sometimes fly in the face of what's really going to be profitable performance for both the manufacturers and the distributors over the long haul. So if you can somehow adopt more of a partnership approach between yourself and your manufacturers, your vendors, then it could create a win-win kind of situation. And to do that, however, it's very important that you understand the economics of the business for a manufacturer, and also, most importantly for this session, that the manufacturers understand what you're going through in your financial and operations on a day-to-day basis. And if they understand you better, then perhaps they can customize their programs in order to be more in tune with what your needs are. And so the idea is, if you're partners, then hopefully you can create a win-win type of situation. So we'll talk about that. Tying in with that also is the fact that the industry has definitely gone through changes over the years. And we at Industry Insights have had the opportunity, as Chris mentioned, to prepare the OPR for the last 31 years, so we've seen a lot. So one of the things I first did last year, and I've done it again this year, is to go back and look at some of the key performance measures as they were 31 years ago and as they are today. And I'll draw some conclusions on some of these major changes that occur. And this ties in nicely with the partners for profit idea, because it's important that your manufacturers understand also some of these changes and what's happening to you. Then at the end, I'm going to spend a few minutes talking about some of the tips for using the OPR, because it is a very detailed report. There is a great deal of information in there, and sometimes you can get overwhelmed by it all. Okay, as you probably know, if you're a participant in the study, as a participant, you receive two separate reports. You receive an overall industry-wide report, and you also receive a customized, confidential company performance report just about your own business. And these two reports are invaluable, I think, for exactly what Chris said, in the fact that they're the only benchmarking type study of this type in the industry. The industry-wide report is made available to you in electronic form. Currently, the individual report is made available to all participants in paper form. In the future, it may also very well be made available electronically as well. Now, the good news is that these reports have a great deal of information about your business. The bad news is they are very detailed. When you're out there fighting the fires or running your business on a day-to-day basis, it's sometimes difficult to find the time, much less the interest, to sit down and pour through a bunch of statistical numbers. Well, the fact is you don't really need to look at everything in the report all at once. You can look at some key indicators and let that dictate what to look at in more depth. And throughout this session, I'm going to be looking at some of those key indicators. So I would suggest you look at some of these same measures that I'm going to be looking at, and then let that dictate what other items you want to look at in more depth. Well, why is this information important? You may have heard me say this before, but the reason this information is important is because to look at the dollar amounts of your performance in your company doesn't tell you all you need to know about your business. You receive regular financial statements, balance sheet and income statements, and other information. If you told me you had $200,000 in profits last year, well, on the surface, I don't know if that's good or bad. If you did $200,000 in profits and you did $2 million in sales, that starts telling me something. That's 10% profits on sales. That's pretty good. If you did $200,000 in profits and you did $20 million in sales, well, that's 1% profit on sales. So that's totally different than the 10% profit on sales. So that's why it's important to look at a financial ratio. Well, just as looking at the dollar amounts doesn't tell you all you need to know, neither does looking at a financial ratio all by itself. For example, if you said, Tom, I happen to be a plumbing supply firm, and my payroll costs, including fringe benefits, were 20% of sales last year. How'd I do? Well, on the surface, I would have no clue. But I know by virtue of having done this study that in this year's study of 2012 results, the typical plumbing supply firm had payroll costs, including fringe benefits, that were 15.8% of sales. So if you're at 20%, and your peers in the industry are at 15.8%, then that raises a red flag to me. Why are you so much different? Is there a profit leak there? Now, keep in mind, this is just a guideline. These industry benchmarks are guidelines. But if you don't know why you're so far off from the industry norm, there could very well be an opportunity for improvement there. So the point here is that major deviations between your firm's performance and the industry norms are not necessarily good or bad, but it's certainly areas that you need to investigate further. And I maintain that you don't have to be a financial expert to use this information. You actually don't have to spend a significant amount of time doing so. You really can get some great insights about your business in a short period of time. The report has a great deal of information, like I mentioned. It looks at pretty much all the main areas of your business, such as return on investment, percentage income statement and balance sheet, expense detail, gross margin analysis, asset and financial management, et cetera, et cetera. So there is a significant amount of information in it. But at the same time, the industry report has something like 99 pages in it. There's like 130 different ratios for 25 different data groupings of types of companies. The individual report that you get is like 30 or 40 pages long and has a great deal of information in it. So it is important to be able to know where to focus your efforts. And as I said, some of these ratios that I'll be looking at here today are the ones I would focus on. The data is broken a number of different ways to try to get as close as possible to an apples-to-apples kind of comparison. It's shown for all firms responding. It's also shown by sales emphasis. In other words, plumbing supply companies are a separate grouping. PVF companies are a separate grouping. There's a separate grouping of companies that are both plumbing and PVF. And then HV, AC, and other is a fourth grouping. Within each of those groupings, there is a data grouping of high profit companies. There's also sales volume size groupings within each of the sales emphasis grouping. We also have data groupings by number of branches And in your individual report, we also have a data grouping of your geographic region, so you can compare yourself versus others in your own region. So that's sort of the layout of the report. It's a significant amount of information. I would recommend looking at your sales emphasis. So if you're a PVF company, look at yourself versus other PVF companies. I would look at yourself versus sales volume, the sales volume group of companies within your PVF group. And then if you want to get more sophisticated, maybe look at the high profit firms that are PVF companies so that you can sort of glean some information from that as well. So in other words, don't try to digest all of the data groupings. They're there if you need them, but just focus on, I would say, sales volume size within your sales emphasis, so that sort of narrows it down to one data group to start off with. And if you do that, in a short period of time, you can get great insights about your business. Okay, before we start looking at the actual results of the study, let's take a minute here and look at what happened in the economy. And this is just in picture form, so it's really not, it's easy to sort of grasp and see what we've already know, and that is throughout most of the early 2000s, the economy was rolling along fairly strongly. Actually, the Federal Reserve was concerned about it overheating, if you will, and they started raising interest rates during this period, and it led to a slowdown in the economy, but then everything fell off the face of the earth when we had the subprime mortgage mess and all that went with that. So we obviously went into a recession, which you see here, and then we've had a relatively anemic recovery since then. That was gross domestic product on an annual basis. This is gross domestic product after adjusting for inflation on a quarterly basis. So it's the same measure that we just looked at annually, but this is quarterly. And the interesting thing here is not only do we see how severe the economic downturn was, but if you take these quarters here that I'm highlighting with the arrow and add up the amount of the decline, it was an 18.9% decline from the first quarter of 2008 to the third quarter of 2009. It took us 9 more quarters, if you start adding them together, 9 more quarters just to get back to the pre-recession levels of sales. So obviously a significant recession. Also interestingly is this negative growth that was experienced in the first quarter of 2008. That was the first quarter of negative growth in 27 quarters. So we had a lot of prosperity before this economic downturn. This is inflation in the economy as measured by the gross domestic product deflator. And as you can see, during much of the early mid-2000s, inflation was creeping up. This caused the Federal Reserve to be concerned. They actually raised interest rates. Believe it or not, this seems like ancient history, but they raised interest rates 17 consecutive monthly meetings during this time period. Well, that led to a slowdown in the economy, as we know, but then the subprime mortgage mess accentuated everything. Fortunately, inflation has stayed under control recently, so the Federal Reserve has felt compelled to keep interest rates low. Unemployment rates, however, have remained very high for several years there, over 9%. The most recent results that just were released a couple days ago is 7.4%, but largely that has come down, most people say, due to lower workforce participation. Well, in general, as long as inflation is low and unemployment is high, the Federal Reserve is not going to be feeling tremendously compelled to raise interest rates. Here's the prime rate. You can see how they were raising interest rates when I said they raised them 17 consecutive monthly meetings, but we've been at 3.25% prime rate ever since 2009 now. Okay, that's sort of the backdrop of where we've been in picture form. Let's take a look now at industry performance over the last 5 years for a number of different measures, and I'm going to show you some graphs that all look alike so that you don't have to try to figure out what I'm showing in the graphs. Each graph is going to have one particular ratio. This particular graph is before tax return on net worth over the last 5 years. And we're looking at all ASA firms participating in the study of this year's study of 2012 results. And you can see that the typical company had a return on net worth of 14.7% this year. You can see how it's steadily improved since we had the economic downturn. Still not to the level it was just before the economic downturn, but has steadily improved. Another graph we can look at is bottom line profits as a percentage of sales. This graph happens to largely mirror that previous graph because it's profit margin on sales that to a large extent is driving return on net worth profitability. And again, you can see how it's gradually improved over the last 4 years. Now, as I go through these charts, it's important to know what's happened in the industry, but when you're actually using this data for your own company, what's important is how you compare to these industry norms. That's where the real value is. And if you were a participant in the study, in your individual report, not only does it show your results already calculated for you alongside the industry comparatives for companies most like yourself or groupings of companies most like yourself, but it also shows your trend performance over time, both in graphical form and in tabular form. So you can track that as well. Asset turnover, sales divided by total assets. And you can see this has been very steady over the years, even during the economic downturn. Financial leverage, which is total assets divided by net worth. This is the extent to which you use debt versus equity financing. So the higher this number means that the more you rely on debt financing versus equity financing. It's basically been the 1.8, 1.9 range, except during the economic downturn when financial leverage was at 1.6 times. And I sort of interpret that to suggest that when we were in the midst of all of the fear that went along with the economic downturn, companies basically shed their debt just to try to prepare for the worst. And that's why it was happened to be low that year, I believe. Okay, another very important measure, and that is payroll costs, including fringe benefits, as a percentage of sales. This is an important measure because of the fact that people costs are a significant cost for the typical distributor. Represents just under 16% of total sales in 2012. Another way you might look at this is that payroll costs represented over 60% of gross margin for the typical industry wholesaler. Over 60% and actually near 65%. So it's managing your people is critically important, and when we take a look at our high profit company analysis, we'll see that that is one of the things that separates the industry leaders from other companies, and that is they do a better job of managing their people. Gross margin on sales. For the typical company, this was 23.8% in 2012. You can see it's actually gone down, slipped somewhat since 2008. Now, for purposes of the study, it's very important that you realize that gross margin does not include vendor rebates within it. In other words, cost of goods sold has not been reduced due to vendor rebates. The reason for that is that when this study was originally set up 31 years ago, when, by the way, vendor rebates weren't as significant as they are now, the powers to be felt that vendor rebates are the buying economies that you take by when you make purchases of product are really financial decisions rather than operating decisions. So they decided that they did not want vendor rebates to be within cost of goods sold, rather to be put as a non-operating income item. Now that vendor rebates have become so important in the industry, more and more companies put this in cost netted out of cost of goods sold, which increases gross margin. But for the purposes of this ratio here, vendor rebates aren't in here. Now, for your reference, we also show vendor rebates as a percentage of sales separately within the report. We also show vendor rebates including gross margin separately within the report, so you really can see it both ways. Inventory turnover, which is warehouse cost of goods sold divided by average inventory. Now again, vendor rebates have not been netted out of cost of goods sold here. If they had been netted out of cost of goods sold, actually inventory turnover would be lower than it shows here. But the cost of goods sold does not take out the vendor rebate. You can see this has been sort of up and down. You can see that during the economic downturn, inventory turnover was very slow as sales slowed down significantly. warehouse gross margin return on inventory, or GMROI as it's called. This is a combination measure that basically includes both inventory turnover and gross margin into one overall measure of return on inventory called gross margin return on inventory. And the way to interpret this is, in the most recent year, the typical company was at 110%. That means that the typical company earned $1.10 in gross margin dollars for every dollar invested in inventory. So they had 110% return on their inventory investment. It's an important measure because it does combine turnover and gross margin into one measure. So you can have a company with a high gross margin and a low turnover and still get a good GMROI. Vice versa, you can get a company that has a low margin strategy but a high turnover strategy to get at the same GMROI. So there's two kind of ways to get to the GMROI, but the idea is to try to maximize what your return on your inventory investment is. So when you're analyzing your own company, if you see that your gross margin is high or low, then you also need to look at the inventory turnover component and see how they combine and what your overall gross margin return on inventory is. Total operating expenses as a percentage of sales. Now this is one that really stands out as a factor that separates out the high-performing companies or the profit leaders from other companies in the industry. Invariably, they have lower operating expenses as a percentage of sales than do other companies in the industry. For the typical company in 2012, this was at 24.3%. It tended to be higher during the economic downturn, which is not surprising because sales declined substantially, which means that fixed expenses were now spread over fewer sales, which caused total expenses as a percentage of sales to go higher. But it has come down substantially as the industry has picked back up. Average collection period on receivables, or days receivables outstanding, those are interchangeable terms. The typical company during 2012 was at 45 days. It took the typical company 45 days to collect their receivables. You can see when we were in the down economy how that went up some as people were stretching out the receivables. But it has come down to 45, still not quite to the level it was at the beginning of the recession, or another way of saying it, at the end of the good times, but it has definitely improved. Net sales per employee. Now this is not an inflation-adjusted measure, so we're looking at dollar net sales per employee here. So there is a little bit of inflation even at low inflation within these numbers as you move from 2008 to 2012. But the typical company in 2012 was at $419,000 of sales per employee. So again, how do you compare to that? If you're at 200,000 sales per employee and the typical industry company is at 419,000 sales per employee, then there may be some inefficiencies there. Maybe you have too many employees, maybe you have too many unproductive employees. Again, these numbers are just to help you raise red flags and see potential areas for improvement. Percent sales change from the prior year. I think the interesting thing here is not that we're surprised on how significant the decline was for the industry. And by the way, these are OPR results. If you add these two here, it comes out to 19.4% decline over 2008 and 2009. If you add 2010, 11, and 12, the sales increases, that only comes out to 17.3%. So that says that for OPR participating companies, they still have not gotten back to the sales level that they had back in 2008 or pre-2008. So I think that is significant. So it's obvious that the industry was hard hit, but it's also obvious that the industry has come back a long way. Okay, that's some of the overall results of the study. Let's take a look at some key measures by industry segment. As I mentioned, we break the data by type of sales. So we have information for plumbing supply companies. We have information separately for PVF companies. We have information separately for plumbing supply and PVF, and then we have HVAC and other. This particular measure is looking at return on net worth, and you can see that PVF companies had a very high return on net worth in 2012, significantly higher than the other segments of the industry. And to try to determine how they got that high return on net worth, you don't have to look much farther than this slide, which is bottom line profits as a percentage of sales. They had much higher profit margin on sales, 4.8%, as compared to the other companies in the industry. All right, what about gross margin on sales for each of the 4 segments? The lowest gross margin on sales was recorded in 2012 by plumbing supply firms. The highest was HVAC and other companies. And interestingly, gross margin on sales for the PVF companies was not significantly better than other companies or the other industry groups. So that suggests that their high bottom line profit margins had to have come through lower operating costs as a percentage of sales. Inventory turnover by industry segment. The highest inventory turnover reported among the 4 groups was PVF firms, followed by plumbing supply companies. But as I mentioned, it's best not to look at gross margin alone. It's best not to look at inventory turnover alone. It's best to look at the measure that combines them both into one overall measure of inventory return, and that is gross margin return on inventory. And if you do that, the highest GMROI for this last year was recorded by plumbing supply companies, or plumbing supply and PVF combination companies. They had $1.22 of gross margin dollars for every dollar invested in inventory. The lowest was recorded by HVAC and other firms. All right, in the study, we also have information that breaks out the large companies from the small companies. And the idea here is that if you're a large company, it might be good to compare yourself versus other large companies, and vice versa if you're a small company. So we have a data grouping of 100 million and over, and a data grouping of 10 million and under in sales. And as you can see, the large companies, based on before tax return on net worth, had a much higher return on net worth than did the small companies, 16.6% versus 4.8%. Investigating that a little further, it's obvious that the reason that the large companies did better was that they had a much higher bottom line profit margin on sales, 4% versus 1.2%. Interestingly, however, the large companies had a lower gross margin on sales than did the small companies. The small companies were at 25.7% gross margin, the large companies 22.5%. So again, the reason that the large companies had higher bottom line profit margin absolutely had to be due to the fact that they had lower expenses as a percentage of sales than did the small companies. And that's not totally surprising because a large company will get certain economies of scale, which helps their expense structure somewhat, but it did not come. The advantage in profit margin and return on net worth for the large companies did not come through gross margin. Inventory turnover. The large companies had higher inventory turnover than did the small companies. Again, looking at GMROI, warehouse gross margin return on inventory, the small companies, by virtue of their higher gross margin percent, even though they did have somewhat lower inventory turnover, did have a higher GMROI. So at least from the standpoint of inventory management, the small companies did better than the large companies. But obviously, expense management was critical that gave the larger companies an advantage. Okay, let's shift gears and take a look at that profit leader analysis. And again, the way we do this is we separate out the top 50% best performing companies based on one measure, before tax return on assets. We put the top 50% in a group by themselves and then run all the statistics for that group of companies to try to determine what led to their high profitability. It doesn't mean that they do the best for each given measure, but it does mean they have the highest profitability overall, so it does behoove us to try to identify what are the measures that they did do best in. And for our purposes here today, we're going to show both the plumbing supply group, the all firms versus the high profit firms within the plumbing supply group, and we're also going to take a look at the all PVF firms versus the high profit PVF firms. So as we do this, it's important to compare the all versus the high profit for plumbing supply and the all versus the high profit for PVF. It's not so important to compare the plumbing supply to the PVF, but within each group, what separated out the high profit from all firms. And here we're looking at sales growth, and you can see the high profit plumbing supply firms did better on sales growth in this most recent year than did all plumbing supply firms. Likewise, the high profit PVF firms did substantially better in sales growth than did all PVF firms. Now, these differences that we're seeing here would be even more dramatic if we showed high profit companies and low profit companies. In other words, the top 50% and bottom 50% most profitable companies. The high profit companies are actually in the all firms grouping. So this would be even more dramatic if we just looked at the top 50% best companies and the lower 50% worst companies. But it's still significant that they did get significantly higher sales growth. Return on net worth. Again, before tax return on net worth, all plumbing supplies companies were 12.3, 20.4 for the high profit companies. All PVF was 31.6. The high profit PVF was 42.9. So those are some significant differences between the upper and lower 50, or between the high profit companies, which is the upper 50%, and all firms, which actually includes the high profit companies. All right, bottom line profits as a percentage of sales is certainly the a key factor that's leading to the high profitability of the high profit companies. You can see that in the plumbing supply group, they have much higher bottom line profitability than do all firms overall. Likewise, in the PVF group, the typical high profit PVF company was at 7.7% profits before tax on sales. Typical company overall, 4.8%. So again, significant difference in terms of their profitability. Well, interestingly, gross margin is not a major cause that has led to the high profitability of the high profit companies in either group. If you look at the plumbing supply companies, high profit companies were at 23.1, all firms were at 23, so essentially the same. They were absolutely the same for the PVF group of companies. So gross margin was not the reason that led to the high profitability of either group, either profit leader group. Operating expenses, however, do stand out as being a big differential factor. If you look at the plumbing supply companies, all firms overall was all total operating expenses were 24.8% of sales. The high performing companies were at 23.5%. So that's 1.3% of sales advantage that the high performer companies are getting just through operating expenses. All PVF companies, also a significant difference. The high profit companies were almost 3% of sales below all firms in terms of what their advantage was on operating expenses. So these are really key differentiating factors. Somehow, the high profit companies in both groups are doing a better job of managing their expenses. And we can look at some other measures, such as non-operating income, which includes vendor rebates, cash discounts, interest income, investment income, sale of fixed assets, and things of that nature. And you can see that while in the plumbing supply group, the high profit companies had some advantage, in the PVF group, there was an advantage to the high profit companies. So it really goes back to operating expense differential between the two groups that has really led to the high profitability of the profit leaders. We can look at individual expense categories, and here I just picked out some of the three of the major ones: G&A expense, occupancy expense, and warehouse expense. And if you look at each of those for each of the two groups, you can see that the high-performing companies did better. For example, G&A expense in the plumbing supply group, all firms were at 8.7%, high-profit companies 7.7%. Occupancy expense, 3.4 versus 3.2. Warehouse, 3.2 versus 2.8. PVF group, G&A, 7% versus 6.2. Occupancy, 1.6 versus 1.4. Warehouse, 3.2 versus 2.5. So by and large, the high-profit companies do a better job of managing their expenses. And my suspicion is, having worked with companies for many years, my suspicion is it's not because they just go out there and unilaterally cut costs. That's certainly not the name of the game. Basically, they find ways to operate more effectively and efficiently, which leads to lower expenses. Okay, some further measures. Inventory turnover. The high-profit companies actually did better in both groups, somewhat better, not significantly, but somewhat better in both groups in terms of inventory turnover. Gross margin return on inventory, which is the combination measure of gross margin percent and inventory turnover. Again, the high-profit companies did somewhat better in this case because they did better in terms of inventory turnover. Because as you recall, gross margin was essentially the same for each segment. All right, payroll and fringe benefits. Certainly a key cost component for the typical company, and the high-profit companies did better in both cases. Now, not significantly better in the plumbing supply group, as you can see, not a significant difference between the high-profit companies and all companies overall, but that would be a bigger differential if we did high-profit companies and low-profit companies, but they did do better. In the PVF group, however, it was significant, almost 2% of sales difference in terms of payroll costs alone between the high-profit and other and everybody overall. All right, gross margin per employee. This is certainly a key measure because it indicates personnel productivity, and you can see that the typical company overall for the high-profit plumbing supply was at $100,000 versus $92,000 for all plumbing supply. The differential is somewhat more even in the PVF group, $155,000 versus $124,000. So obviously personnel productivity, personnel management is a key factor here. And something that I've found in studying this, and I think I have some data here I'll still show you, is that even though the high-profit companies almost always have lower payroll costs as a percentage of sales, they also almost always pay their employees better. So they have lower payroll costs as a percentage of sales, but higher pay per employee. So it obviously goes down to the fact that they're getting greater personnel productivity out of their people. Average collection period on receivables. Again, the high performers did somewhat better. 48 days versus 44 days for the high performers on the plumbing side. On the PVF side, all firms were at 49 days to collect the receivables, 46 days to collect the receivables for the high performer group. Financial leverage. Again, high performers in this case were a little bit less highly leveraged than were all firms overall in both groups, which means they relied a little bit less on debt versus equity financing. Okay, so what are some of the conclusions from looking at these profit groups? Well, these things that we find pretty much are consistent every year, and they certainly have been consistent this year for both the plumbing supply group and also the PVF group of companies. And that is, first of all, the high profit companies had much higher sales growth. They also had higher profitability, which is no surprise because that's how we separated them out in the first place. But a big part of it was they have higher bottom line profit margin on sales, even though gross margin was largely the same, if only slightly higher. They have higher inventory turnover, and they have higher gross margin return on inventory. They get greater personnel productivity, but in the sense that they have both higher gross margin per employee as well as higher sales per employee, but they also have lower sales costs. Their operating expenses are much lower as a percentage of sales, especially G&A expense. They also tend to have somewhat lower average collection period on receivables, and also similar financial leverage, although it was slightly lower. So that's sort of what we can learn by looking at the high-profit companies. Operating expense is a huge factor. Personnel cost is a huge factor. Gross margins are not necessarily a huge factor, but inventory turnover was significant, which led to their higher gross margin return on inventory. Now, I've been sort of rolling along here. I don't know, Chris, have you had any questions at this point?
None so far.
Okay.
Oh,
well,
wait, yes, I do have one.
Okay.
When looking at occupancy expenses, do you get info on owner-occupied or related party ownership, which potentially affects rental rates?
That definitely affects rental rates, and we ask for occupancy expense, and it could include rent, or if you're paying a landlord, or it could include depreciation costs in there if you're occupying it yourself. The way to look at it, I think, is the fact that either way, it still is a factor in the overall scheme of things in terms of what your bottom line profits are. So if you see it high or low, and you're an owner you're an owner renting it back to the company, and you are taking higher than market rents as a way of taking out money out of the company on a tax sheltered basis, which is a good thing to do in most states anyhow, then you need to just factor that in as you're analyzing your own results. So that would probably lead to your rental, your occupancy expense being somewhat higher than the industry norm, but you know why it is. And that's the whole, that's the most important thing, is if you are different, to know why it's different. If, on the other hand, your occupancy expenses are significantly higher than other people and you don't know why, then that's something that you need to look at in more depth. Now, when I do business valuations, one of the questions I ask is, do you own your own facilities personally or in the company? And if you own it personally, do you take higher than market rents or lower than market rents? And therefore, I have to adjust the financials accordingly, because if you're taking higher than market rents, that really is profits that you're taking out of the company, and that has to be a profit add back to your financials, which enhances the value of your business. So, and now you might be thinking, well, if we have a lot of companies that are a lot of people that are owning the facilities and then doing that, taking higher than market rents, does that screw up the industry numbers? Well, basically it doesn't, because we use industry medians rather than averages, and any outlying situation doesn't affect the median. So as a result, we really get what's sort of the true picture within the industry, but when you do your own analysis of your own company, you need to make that mental adjustment if you're taking high rents.
Okay, thank you. Now, before I get to Jake's question, I do want to remind everybody that there will be an opportunity to access both the replay of the recorded webinar as well as to download a copy of the presentation slides. So, Tom, I've got one more question, it looks like. Sure. Here. Jake asks, how does company size factor into high profit versus all firms?
That's an excellent question, because one thing we do look at every year is we look in that profit group to see if it's skewed, among the big companies versus small companies. And invariably, we find that there are both small and large companies that are found within the high profit group. I think this year it was somewhat more large companies than small companies, but it was still probably a 60-40 mix. And other years, it's the other way. So I think it boils down, in my mind, it really boils down to who's doing the most efficient job of running their business as opposed to necessarily size. And I've heard small companies say, well, large companies are by definition going to be more profitable because they get economies of scale. I've heard large companies say small companies are going to be more profitable because they can have more hands-on management of the business. Well, I found that it really doesn't matter. It's really how you run your business. Okay.
Okay, thanks, Tom. We're
All
ready
right.
to continue.
Okay. As I said, I wanted to shift gears a little bit and talk about something that I think is closely related to the OPR, but it's very important, I think, and that is to establish a partnership approach with your suppliers. And the idea here is that if you are winning, your suppliers are going to win also, and vice versa. I think historically there's been sort of a largely an adversarial relationship between distributors and the suppliers, largely because there tends to be a short-term orientation trying to get the best price on a buy if you're a supplier, or if you're a distributor, and if you're a supplier trying to get the biggest sale possible with your distributors. But if you take more of a partnership approach and each understand what makes the other tick, I think you can create a long-term win-win situation. And I have actually seen this happen. Now, it might sound unheard of, but it does happen. So I want to show you some ways that distributors and manufacturers are a little bit different so you can help understand each other, and then show you some of the sensitivities on the distributor side that it's important for manufacturers to understand, because if they understand you, they're going to be able to do a better job, I think, of relating to you. I'll mention the 30-year fixed shifts that have occurred in the industry, but it's also important that both sides know where each sales dollar goes and what the profitability challenges of each side is. And also look at the wholesalers versus the manufacturers from the standpoint of what your actual P&Ls look like and how they are different. And then, as I said, I'll take a look at some of the sensitivities involved, primarily on the distributor side. What kind of things affect profitability and how much, even with small improvements? Well, what about the 31-year shifts in the industry? To do this, and some of you may have seen this before, I first last year was asked to take a look at going back how the industry was 30 years ago versus today. And to do that, I took some key measures. I looked at a 5-year average from 1982 to 86. And then also look at a 5-year average, and I've updated this for 31 years now, from 2008 to 2012. These are good comparisons because of the fact that both of these 5-year periods involve significant economic downturns and subsequent recoveries. So, and taking a 5-year average is better than just looking at a 1-year average, obviously, because it smooths out any idiosyncrasies of a given year. Well, having done this, first of all, gross margin, defined as we've already defined gross margin, not including vendor rebates or cash discounts. Gross margin for 31 years ago during that 5-year period was 24.8% versus 24% today. So gross margins have gone down somewhat. Payroll and fringe benefits as a percentage of sales have gone up substantially for the typical company in the industry, from 13.8 to 15.8, a significant difference. Total operating expenses have gone up significantly also, largely due to the big increase in payroll costs. Operating profit, which is defined as gross margin minus operating expenses, was 2.4% for the typical company back then, and it's actually a negative 0.4% today. So that has deteriorated significantly. Well, fortunately, vendor rebates sort of saved the day, because vendor rebates only represented 0.4% of sales back then and now represent 4% of sales. So a huge increase in terms of the importance of vendor rebates, which says to me is if you don't want to be a partner with your manufacturer, in effect, you really are already. Because largely or primarily due to the increase in vendor rebates, bottom line profit margin on sales, profit as a percentage of sales, is the same today as it was back then, the same today. Return on assets is exactly the same today as it was back then. Inventory turnover, exactly the same today as it was back then. Gross margin return on inventory is down slightly today due to the fact that gross margins are down somewhat. So I think the point can be made is that vendor rebates are huge today. So your relationships with your suppliers are huge. And as a result, it's important to sort of think about at least this partnership approach, which I'm sort of proposing to you. As a matter of fact, I'd almost recommend that you should show some of these slides that I'm about ready to show to your vendors so that they have an idea of what you as a distributor in the industry is going through. And in particular, this is a P&L of a typical distributor in the industry based on this year's results. And you can see here an operating profit for the most recent year was a negative 0.5%. The most recent year gross margin was 23.8%. Due to primarily vendor rebates bringing non-operating income up, the bottom line profits for the typical company was 3.1%. But you have very thin bottom line profits in the industry, very thin. And if your manufacturers don't understand that, you need to show them this chart because it's much different than what they experience. As a matter of fact, we can look at side by side sort of an abbreviated P&L for the typical distributor in the industry versus a typical manufacturer, realizing that all manufacturers are somewhat different, but a typical manufacturer. And things that jump out. Gross margin for a typical manufacturer is much higher than it is for a typical distributor. Operating expenses tend to be somewhat higher for the manufacturers because they probably have more fixed costs due to their manufacturing facilities and whatnot. Operating profit, however, manufacturers don't face what you do in terms of operating profit. They're showing a healthy operating profit, which is gross margin minus operating expenses. Due to the vendor rebates, you are getting to a positive level of profitability, but it's still bottom line profits for a typical distributor is still very thin typically as compared to the typical manufacturer. So I would show your manufacturer friends this as well because they need to understand what you're going through. They need to understand how important operating expenses are for you, the fact that the vendor rebates are critically important for you, and they need to just understand you in general. And vice versa, it's good that you understand them as well. Looking at some other measures, inventory turnover, and this is total inventory turnover, so it's not just warehouse cost of goods sold, it's total cost of goods sold divided by average inventory. Typical distributor tends to a little bit behind. Asset turnover, the typical distributor is somewhat higher, mainly because manufacturers have a lot of fixed assets. But your overall profitability in terms of return on assets and return on net worth is typically somewhat lower than that experienced by a typical manufacturer. So bottom line profit margins are thin for distributors. Gross margin is lower than for manufacturers. Operating income is negative. Productivity is critical, and we've identified some of those shifts that have occurred over the years. Now, if you have a manufacturer that wants to load you up with inventory, I say show this chart. And in particular, let me just take you through it. It's sort of, you may have seen this before. Let's say you start off with $1 million of cash. You use it to buy inventory, which I'll call inventory at cost of $1 million. You then mark it up for, we'll say 20%, so you now have $1,200,000 of inventory for resale. You presumably sell it, which if it was a cash sale, it would go up to the top as $1.2 million of new cash. It's probably going to be a credit sale, which becomes an accounts receivable, then is collected, and now goes up to the top again as $1.2 million of new cash, which is then money that you can put through the cycle again. So the idea is the more times you can put it through the cycle, the more successful you're going to be. It helps your cash flow, it helps your profitability. If, however, your manufacturer loads you up on inventory and it's stuck in your warehouse, it's like having piles of $100 bills sitting there gathering dust, crimping your cash flow and hurting your profitability because it's money that's stuck here and not going through the cycle. So that's why turnover is critically important. Now, obviously, the markup is important too, so it's not all turnover, but turnover is important, and I think that sometimes gets lost in the shuffle. Also, you have a situation where inventory excess inventory has costs associated with it. And I've just identified some of those costs, what they might be. Capital costs in this day and age is not probably 5% or 8%, it's more like 3-4% for the typical company. But when you add up all these different possible costs of your inventory, it's not unreasonable to say that excess inventory might not be costing you 20 to 25% of the value of the inventory. So if you have $100,000 of excess inventory, that might be $20,000 to $25,000 just in inventory carrying costs alone. So again, if your manufacturers want to load you up with inventory, you might want to show them this chart too. Also, it's important that your manufacturer do what they can do to help enhance your sales. And they do this through brand awareness, advertising, or whatever it is that they may do. But it's important because incremental sales increases really are important in dropping a disproportionate to the bottom line. For example, let's say you're a $10 million company, your cost of goods sold are $8 million, and we'll just make an assumption that this volume level, your variable expenses, which are expenses that are, go up or down with sales going up and down, we'll say that's 8% of sales or 800,000. Fixed expenses at this volume level, we're going to say are also 8% of sales. And for this little example, that drops $400,000 to the bottom line or 4% profit. Let's say, however, you figure out a way of getting $1 million of new sales or 10% sales increase, and you do it by not cutting costs or cutting prices. So your cost of goods sold is still 80% or 800,000 of the new million. Your variable expenses, which go up and down, the sales go up and down. And I'm not getting into semi-variable expenses here for illustration purposes, but we'll say that they are still 8% of sales because they're variable expenses. So they're now 8% of the new million. So, but however, you do not have any new fixed expenses. So everything else drops to the bottom line in terms of profit. So you now have $120,000 profit on the new million of sales, which is a 12% profit margin on the new $1 million of sales. So that's why incremental sales are important. And if your manufacturers can help you get those incremental sales, that's going to help you. Or if together you can plan and get those incremental sales, that's going to help you. Okay, as I mentioned, there are some sensitivities involved in your business that can lead to high profitability. And I'm not going to get tangled up here in terms of the mathematics of this. I'll leave it to you if you want to look at it later, but I'm just going to sort of show you the overview of it. Let's say we have a representative company, and here's their P&L, here's their inventory dollars, here's their inventory turnover, receivable dollars, etc. Well, what if this company can somehow figure out a way to get a 5% expense reduction? Not 5% of sales, but a 5% expense reduction. Well, if they can, I've done the mathematics, and we don't need to get tangled up in that. If they can, then what happens is their bottom line profits goes from $980,000 for this company we're looking at here to $1,285,000. So almost or over $300,000 drops to the bottom line if through some efficiency way, not unilaterally cutting costs, but some efficiency way, they can get a 5% expense reduction. So that is significant. Okay, what if going back to the original company before the expense reduction, let's say they can get a 5% sales increase. Well, again, doing the mathematics, profits go from $980,000 to $1.1 million. So again, a substantial dollar increase. And if you're giving people bonuses based on the improvements, that's significant. What about inventory turnover, going from 3.6 to 4.1 times? Well, I've done the math again. The profit impact is $121,000, also significant. What about gross margins, going from 20% to 21%? Well, that would cause, in our little example, bottom line profits going from $980,000 to $1,280,000. So these are all significant. And the point of this is to see the sensitivities involved. And I've done the mathematics here, but you don't have to do that. If you're a participant in the study, then you have something that came with your individual report called the Financial Insights tool. And it's a very simple little tool which already has your numbers loaded in it, already has the industry numbers loaded in it, and you can just make some of these little changes and assumptions, very much like I've done here, and it'll show you what the impact is on your profitability. So if you've never looked at that, you might want to spend a couple minutes looking at it because it really is revealing, I think. Also, ASA has a seminar series that does this very thing and gets into a great deal of depth called the Essentials Seminar Series, I believe, that will take you through and also teach you some of this same thing. I think it's useful, again, here in the context of this partnership approach, because if both you and your manufacturers or vendors understand the difference, or excuse me, understand the sensitivities of your business, then it's going to help both of you understand how to plan for the future and get out of these traditional relationships, which are sort of adversarial, which are sort of short-term oriented rather than long-term oriented. You know, your suppliers have a great deal of information that they probably have at their fingertips. Research information, sales trend information, economic growth projections, that kind of thing. If they sat down with you and shared that information with you, and you shared with them some of these very things that we're talking about here today, then hopefully you together you can plan in a way that's not short-term oriented, not where the manufacturer is trying to get the biggest possible order on every sales call, or you're trying to constantly hammer the best price on every order, but you plan in a way, in a partnership way, which everybody wins. And that's the whole idea of this. Okay, that's the partnership approach. Just a couple last comments. The OPR is very detailed, but it doesn't have to be overwhelming. If you just start off looking at the key measures that I've looked at here today, let that dictate other things to look at in more depth, you can get a great deal of information in a short period of time, and recognize that as you see red flags, it's not necessarily good or bad, but it's something that you need to understand why you might be different. And where should you focus your efforts? I'd focus it on the things that have separated out the high-profit companies, such as operating expenses, personnel management. I'd start right there. Those are key areas. Okay, Chris, I've gone a couple minutes over. Do we have any further questions?
At this point, I don't see that we have any further questions.
Okay. Well, I want to, again, thank everyone for being here. I've put my phone number and email address on the slides of the webinar. By all means, if there's anything that I haven't made clear here or you have any questions, just give me a call or shoot me an email, and I'd be happy to try to respond.
Why don't you go ahead and advance to that last slide so people can see the phone number?
Oh, okay. There it is, yes.
Well, thank you. And thank you, Tom, for an excellent presentation, and to everybody for participating in today's webinar about the American Supply Association's 2013 Operating Performance Report. Again, this webinar has been recorded for replay, and all of you will receive a follow-up email message with notification as to when the replay is available, as well as instructions on how to access it and the presentation slides. By the way, there's still time to book a room and register to attend Network ASA 2013 in Washington on October 2nd through the 4th. And if you do so before September 1st, you'll save $100 per person. With more than 70 wholesaler firms already registered, we are well on our way towards reaching our goal of having 100 wholesaler firms represented. And all indications point clearly to a very successful convention. Visit www.asa.net for complete information. Lastly, please mark your calendars to participate in ASA's next webinar, scheduled to begin at 2 o'clock Eastern on Wednesday afternoon, August 14th. Alan Bolio with ITR, Industry Trends Research, will present his next economic forecast webinar for the PHCP and PVF industry. This program is especially for ASA members and will help them to see what's in store for the remainder of this year, as well as offer a preview to the 2014 industry forecast presentation at Network ASA. Contact Delia Berger at 630-467-0000, extension 208, for information on how to register for this members-only program. Again, I'm Chris Murin, Executive Director of ASA, and this webinar is now concluded. Good afternoon.